It's time to get to the real stars of our program today. We have with us four investor people and Abby Lyle from Tribeca Venture Partners. Where are you, Abby? There you are. All right, she's smiling. See, and then Gina Tedesco. Gina, all right. Thank you for joining us. Maria O'Brien. There she is. She's from SOSB. And then Mario Casabona from Casabona Ventures. Certainly all popular figures in the entrepreneurial scene in New Jersey. So I'm going to go to each one of our panelists, and they're going to spend a couple of minutes telling us what they do and introduce themselves so you get to know them a little bit better. So why don't we start with Abby? Welcome to the program, Abby. Thanks so much. And tell us about yourself and what you're doing.
Thank you so much for having me, Richard. Hi, everybody. It's great to be here. My name is Abby Lyle. I'm an investor at Tribeca Venture Partners. Tribeca Venture Partners is an early stage venture firm focused primarily on investing in tech companies in the tri-state area. So we have a strong geographic focus on New York and surrounding regions. We're a Series A lead investor mostly, typically write checks in the $3 to $8 million range. Occasionally we do a seed, a smaller check, but that's kind of the bread and butter. We're totally sector agnostic within tech. So as long as there's a technology component, we will invest. The only sectors we don't look at are CPG and biotech. We've been around since 2011 and we're on our third fund. I've been a VC since 2016, started my career running an early stage startup accelerator called Quake Capital, and then spent 3 years at a firm called Big Idea Ventures that was focused on food innovation, which is where I met David Postolsky and worked with the Gearhart team on all of the IP protections for all of our portfolio companies. So thank you again for having me. Looking forward to the discussion.
That's great. Is Tribeca Venture Partners, is it actually in Tribeca? Is that where you are at? Okay.
We are. I'm working from home today in the financial district, but our office is on Hudson and Franklin Street.
Right. Gina?
Hi, nice to be here. Good to see everyone. Always like helping entrepreneurs learn a little bit more about how the angels think and the other investors think. So I'm an angel investor. I'm the managing member of Amala Ventures, which is my own investment vehicle. I invest through angel groups. So I'm a board member of Jumpstart New Jersey, as well as the New Jersey chapter lead and member of Golden Seeds. I also organize the Golden Seeds annual funds. So we have funds and we make individual investments. I also invest in Brazil. We have an accelerator there. I started my career as a mechanical engineer. I worked overseas. My industry experiences was in pharma. I founded a biotech company here in New Jersey. So I was on the other side of the table a long time ago. I exited that company and a couple other companies, and I've been a professional investor for about a dozen years now. I invest in diverse teams. One of my investment criteria is there needs to be a woman in the C-suite as part of the co-founding team with influence. And I look for innovative and disruptive technology here in the US and also Brazil. So I'm pretty industry agnostic as long as there's an amazing team looking at innovation and the next big thing.
Sounds like you're keeping busy. Why Brazil?
My husband's actually Brazilian. I lived in Brazil, lived overseas. So I lived in France, I lived in Brazil. So I do have that international experience, and we founded an accelerator there. And it's a booming tech community down there in Sao Paulo. So,
oh, wow. I didn't know that. I've been to Brazil a couple of times. It's like Sao Paulo
yep.
and Rio both, and some of my favorite cities. So
yep.
Very cool.
Yep.
Maria, tell us about yourself.
Thanks, Richard. Thank you. And thanks to yourself and Elizabeth and David, of course, for the invitation to contribute to today's panel. Really looking forward to it. So my name is Maria O'Brien. I am in-house general counsel with SOSV. Not quite as amazing a location as Brazil, but not too bad nonetheless. I'm located in the Cork offices in SOSV, which is in Ireland. And we also have offices in San Francisco, New York, Newark, Shenzhen, Shanghai, and Tokyo. I have been working with SOSV as in-house legal counsel since 2015. SOSV itself is a global multi-stage venture capital firm. We operate pre-seed development programs. So notably, I suppose, HACS would be our hard tech program. IndieBio focused on human and planetary health. Orbit Startups is really our program focused on helping teams expand into new and frontier markets. And then DLab, which would be our crypto-focused program. Our core mission at SOSV really is to fund visionary deep tech founders, to have a profound impact in the areas of primarily human and planetary health. We look to invest in founders really who have, a focus on solving big problems, dealing with big challenges, who are building groundbreaking tech effectively. Our own managing partner is Sean O'Sullivan. He is New Jersey based. He is deeply committed to social betterment through entrepreneurship and technology, and that really feeds down through our own portfolio within SOSV. The goal in each of our development programs is to help teams prove out their value effectively by getting increased scientific and marketplace traction, and increasing clarity about their own products and positioning in their relevant sectors. And at that point, then, the focus shifts somewhat to fundraising and introductions to top tier investors.
Great. Well, I first of all, I have two questions. First of all, you must be Irish, because I was wondering about your accent. Are you
Yes, I
Irish?
am. I am
Okay.
Irish. Yes.
And then the second thing is, what is a groundbreaking technology? What does that look like?
Like at the minute, we really are focused on, there's a real core focus within SOSV on, as I said, the human and planetary health. But that is so broad. I mean, our portfolio is vast. It is a very large portfolio. There is scope within each program. We do not have any strict requirements in respect of any team that wants to apply to the program. It's a very open based on application, based on discussions with the relevant GPs. But it is, I suppose, something that is going to improve the lives of ordinary individuals. Climate tech, we have a significant decarbonisation fund that is extremely active. We have GPs that are very committed, in addition to Sean O'Sullivan, in those areas. So, we're very open to accepting applications in any of those fields, and happy to make introductions to the relevant GPs as well.
That's great. We really appreciate that. Thank you, Maria. Mario, you're next. So
Yep.
What can we say?
Mario, thank you. And by the way, happy to be here, delighted, supporting anything you do, Richard and David. You're one of my people I enjoy being with. So
Yes, Mario,
Mario,
we knew you'd be an easy catch for this program too.
Yeah. So Mario Casabona, founder and managing director of Casabona Ventures. And I really started my career as an engineer in the defense industry, built my company, Electro Radiation Incorporated, sold it to Honeywell in 2004. And then I was with them for about 2 to 3 years. In 2007, I started Casabona Ventures with the primary objective, number one, giving back to the community. And number two, investing in startups, seed stage startups, and hopefully making some money at it. But it turns out that I'm having more fun than I'm making money, that is. So since 2000,
they're not mutually exclusive though, are they?
No, they're not. But so in 2007, again, started Casabona Ventures. And at the same time, I joined Jumpstart New Jersey Angel Network, which is a group of like-minded individuals similar to Gina. She's also a member. Between then, 2007, and now, I probably have about 30, 35 companies in my portfolio. Very few will be home runs, and the rest, some of them should just stop. And some of them are just going on and won't stop. So let's see, what else? We invest personally my money invests in seed stage, early stage companies. Oh, and the other thing, back in 2012, I wanted to support startups, and I started a company called techlaunch.com. We provide, now I refer to it as a business accelerator. And primarily we provide mentoring to startups. And then we choose 3 startups that we have them present at what we call the bullpen, very much like Shark Tank. And then whoever the winner is gets to present to some of the angel groups in the metropolitan area. What else? That's really about it. Thank you.
Well, you've been you've been a pillar of the New Jersey entrepreneurial community for a long time. And my microphone sounded weird there.
Oh, yeah, that's because, again, please do not take yourself off mute yet.
Oh,
thanks.
okay.
Not you. Thanks.
All right. I thought my voice had changed. Anyway, so on to the questions. And Mario is our first victim. What are the stages of investment, and what are the types of investment that entrepreneurs might take advantage of?
Sure. Well, to start from the beginning, as far as a entrepreneur is concerned, when I started my company, I really had a few options, 3 options that I looked at. One was a bank loan, going to a bank, local bank, and requesting a loan. And it's a really difficult process, like any other when you try to raise capital. The thing about a bank loan is, though, that you usually have to provide some kind of collateral, either your home, your kids, or your ex-wife, or something like that. And but it's collateral. That's the main thing. And then the other option is you go to venture capital, either angel investors or venture capitalists, which we'll talk a little bit more later on. And that's also difficult. So it's not that easy. You have to show your investors your ability to manage your company, execute your business plan, and hopefully be successful and exit. The other option is bootstrapping, which is what I did, basically taking my vacation money and investing it in my idea. And it usually bootstrapping takes quite a long time for an exit, but at the same time, at the end of the whole process, you own a majority of the company. Then the other thing I'd like to talk about is funding cycles. So I'm an entrepreneur, and I'm looking to raise capital. What's really the first area that I can look at? Well, we usually, as investors, we look at the friends and family portion, where basically you go to an individual, an aunt, an uncle, your father, a family member who loves you, and they're willing to give you some seed capital. And in a lot of times, this capital is not, it doesn't come with too many strings. It's usually, again, very much of an emotional investment in your idea. But it's typically $25,000 to $50,000, and it really provides enough capital for you to perhaps write the business plan, maybe do a minimum viable product, and think about more about what you're really getting yourself into. And along with the friends and family cycle is also accelerators, right? Tech accelerators. You apply, you get accepted, you'll get some sort of funding, but more importantly, what you get is feedback, you get knowledge, you get expertise to help you build your business. And that's usually what we refer to as the pre-seed stage. Then the other portion of the cycle is the angel investment community, where you go to either a network or an individual that probably understands your product, probably understands the industry, really likes you and is willing to make, I'll say, a little bit of an emotional investment, although it's, we still try to make money and we still do due diligence. I'm primarily in the angel investment cycle. Usually you'll get high net worth individuals that'll make that investment, or you can go to a group like Jumpstart New Jersey Angel Network, and there you make a presentation and you can raise some capital. And then after that, if you're successful raising capital and demonstrating that you know how to run a business, you then go to the venture capital community. And that's usually more of a growth stage, and it's usually more structured in that area. What else? So that's sort of in general. Now, again, all three, it's not that, siloed. There's also a lot of things in between. Then the next, which is really probably more important, and it's something Richard wants me to address, is, and David, is the difference between an angel investor and a venture capitalist. Okay. So as an angel investor, it's usually an individual or a group of investors who pool their personal money and resources to invest in an early stage company. Okay. Let's say they're usually affluent individuals, and they meet certain Security and Exchange Commission criteria, also known as accredited investors. And the investment is usually between about $25,000 to up to about $1 million. Individual investments, it can run 25 to about 100,000 typically. And as a network, as a group, anywhere between 250,000 and about $1 million. Now, I don't know if you've heard about super angels, and those can invest 500,000, $1 million, $2 million.
Those could be family offices, for example.
Yes.
In some cases.
Yep. If they invest at seed stage, right? So there's some say they'll invest at early stage, but even at most of the companies that are seed to even growth, they're considered early stage. But you're right, so family offices might.
My takeaway from Mario's commentary is that if you forgot to send somebody a birthday present in your family, missed a birthday party, you've cheesed off a relative, go make friends with them long before you start your business, because then you'll be able to take advantage of the family and friends around. So that was great. Mario, it's time for another question, and this is addressed to everybody in the panel. Has COVID changed how you've invested? So why don't we start with Maria? She looks like she has a ready answer for this.
I suppose, look, yeah, COVID was a precarious time. A lot of teams within our portfolio did very well through the pandemic. A lot of them, some of our top performers were able to pivot very well, were able to, engage with the circumstances. They were able to adapt, I suppose. Easier maybe for earlier stage teams to do than later stage companies. But generally speaking, we continued to operate our programs throughout the pandemic. We continued to invest. We continued at the levels that we had anticipated throughout the, we'll say 2021, 2020. Across our 4 primary programs each year, we would invest between 100 and 130 teams. So we continued at those levels. But certainly the follow-on rounds were quite astounding through last year anyway, 2021. I think there's no doubt that 2021 in respect of round sizes and pace was an exception rather than a norm. But I do think, as of now, there's a return to somewhat more traditional valuation metrics, etc. Certainly not maintaining the highs of 2021, but that would be our position anyway, I suppose, from SOSV.
That's great. So it really didn't change too much. Gina, how about for you?
So I'll give kind of the investor side because I thought it was really actually an interesting change for Golden Seeds. So Golden Seeds, if anyone doesn't know, is a nationwide network. That's one of my angel groups. I'm the chapter lead in New Jersey. We have 8 chapters throughout the nation. We have about 350 angel investors, and we also have a venture fund and an annual fund, which I also am part of. What happened to us was that our organization became more national because everything moved to Zoom. It became much more efficient. We were able to actually see more entrepreneurs. We started our New Jersey chapter in February of 2020, which was actually interesting because we had one in-person meeting and then everything went online. And we were actually able to connect and grow that chapter during COVID in terms of investment. Also of note, the markets rebounded pretty quickly. So we had our best investment year funding companies, which I don't find unusual. Usually during times of turmoil is the time when innovation happens. And that's what happened during 2020 and 2021. So I think our investments were probably close to a record for the Golden Seeds organization, and myself included. So I think it was a positive. There was a silver lining in terms of the groups becoming more efficient and being able to syndicate across even angel groups across the nation.
Wow, well, that's really, that's an interesting breakthrough, which probably wouldn't have happened but for COVID, and it's probably continuing, right? So
I believe so.
Yeah, absolutely. Yeah. And I think we've seen that in a number of different areas, certainly in our practice too. Abby, what happened in Tribeca when New York City was closing down? What was happening in your investment world?
So something that's interesting that's certainly changed and is perpetuated still today, the idea that you would invest in someone that you've never met in real life is very new. And that's definitely something that started during 2020 and 2021. I think prior to the pandemic, the idea that you might write someone a check after only having spoken with them on Zoom was absurd. We never would have done that. And now it almost seems normal. And we've done several deals that way, both at TVP and at the firm that I worked for previously. So that's definitely been a change. Another change that I've noticed, especially as a firm that's very geography focused, very focused on companies that are based in the tri-state area, a lot of teams have gone remote and have gone virtual. So, because we had that geographic focus, one of the first questions that I always ask founders in pitch meetings is, where are you based? Where are you located? Used to be a straightforward answer. Now people look at me like I have 3 heads. So
what does it matter, right? Yeah,
exactly. So we've had to kind of rethink our thesis a bit with regards to that geographic component, because there's a lot of companies that are distributed teams, and they've got 5 people and they're all in 5 different cities, or the dev team's located abroad, or whatnot. So we've definitely had to make some.
What about the levels of investment? I mean, were investors still feeling comfortable about investing in companies, even though the pandemic could have wiped us all out? Or I guess the money's no good if that happens, but
I agree with all the comments mentioned previously. I mean, if you look at the data, 2020 and 2021 were very exuberant years for venture investing, and there was lots of capital deployed. I think for us, we took a bit more contrarian approach. Valuations are another big factor to consider when making investments, and we're very price sensitive as a firm. So because of all the investor exuberance during 2021 in particular, and all the capital that flooded into the market, we found that a lot of the great deals that we were interested in doing were too expensive and were just at prices where we didn't feel comfortable. So we didn't stop completely. We certainly made some investments, but we mostly spent 2020 and 2021 focused on providing liquidity to our LPs, which is another very important end of the venture investing ethos. So we had 2 IPOs in 2021, took advantage of all the liquidity that was present in the public markets to return some of the capital from our previous investments. And now that 2022 has rolled around and a bit of a downturn has set in, we're looking to start deploying more capital into some of those great businesses that may now be available at more reasonable valuations.
See, you sound so smart. And so that's so I know you are. So, but I'm going to turn the table a little bit to Mario. You know, the used to be that angel investors wanted to invest in companies locally, so you could go down and see them, right, and talk to the people, and it made meetings easier. It sounds to me like investors are sort of getting away from that requirement now, right? What's your thinking on that?
Absolutely. In fact, if you were to ask me 2 years ago, I would say, yeah, within an hour and a half, 2-hour driving distance, right? Because I want to go and touch the company. And it turns out, because of the whole COVID situation, it took a few months, but then I got adjusted to Zoom virtual meetings. And the first thing I really did in 3 to 4 months is really double down on my existing investments, right? Because I wanted to make sure that they would be able to go through the next year or two of the pandemic or the situation. But what's really happened is what you're saying, Richard, is that there's really no geographical boundaries. It's now we go to the Midwest, we go out to California, the West Coast, and it's all done by Zoom. But at the end of the day, that probably still requires 1 or 2 meetings, okay, physical meetings,
Right.
which is now possible, to actually make that investment, okay?
Right.
But where before you'd have mostly face-to-face, now it's mostly virtual, and then 1 or 2 face-to-face meetings to make the deal happen.
Okay. Yeah, it's amazing how it's changed. And even the other day, I was talking with some angels, and they were like, well, we're just going to go, they're in Manhattan, they're just going to go down the street and see the company, right? And there's like 2 people there, but the company made it a point to get as many people in the office as they could, you know, during this due diligence process. So the personal connections are still important. It's just, I don't think that they're as necessary as they were in the past. So let's get into the nitty gritty. What do you look for in a company when you want to make an investment? Gina?
So I have a very specific criteria because I truly believe that diverse teams have better returns. So I always look for the team first. Do they have a woman in the C-suite? Do they have diversity in the C-suite? Diversity of, and that could be of anything, geography, you know, background. So that's kind of my personal criteria that aligns with, obviously, my involvement in Golden Seeds, because that's one of the tenets that we look at. The other thing I look for is really that they're solving a big problem. I mean, I want to invest in a company that has a vision, that has a technology they're seeing around the corner to see what's going to happen. So it's really that entrepreneur that's passionate about something, that sees something that maybe somebody else doesn't see in that white space. So I'm always on the lookout for that. And then, you know, of course, we want to, you know, Abby mentioned price. We obviously want to get, you know, a return on investment. So we want to make sure that we invest at a value where the company's at. And I was looking at some statistics the other day, and interestingly enough, during that, you know, kind of crazy market froth, the early stage companies did not actually, the valuations were not as frothy as later stage companies. So there was still some value in investing early, and, you know, also, as everyone said, shoring up the portfolios. So you really want to make sure that you're in it for the long haul, and that you're looking for those companies that you're going to support to really change things.
So just, I mean, just as a note, I mean, these are all very nice people, our panelists, and they want to support entrepreneurism, but they're not philanthropists, right? They're in it to make money. So you have to have your act together as a company before you go knocking on doors to make sure that you give yourself the best possible chance, right? So Maria, what are your thoughts?
Yeah, absolutely. I would agree with what Gina has just said there. You know, team is so important. It's you know, especially because we come in so early, the team is really core. But fundability, yeah, you know, the team has to be fundable. There has to be you know, something there that is scalable. We generally look to focus on teams that are building value, you know, that have managed to retain, you know, bootstrap as much as possible, retain as much equity as they can at the early stage, that they're showing traction, there's growth potential. You know, we start the relationship, I suppose, with our teams very early at the pre-seed stage, but we do try to continue and maintain our pro rata throughout the life cycle of the company, the investment life cycle of the company. And generally, we only invest in teams that have graduated from our programs, from one of the SOSV development programs. So the programs tend in some way to act as our in-person DD in respect of the teams, which, you know, which is really efficient process for us to some degree, and allows us to really build up you know, a strong knowledge, I suppose, in respect of each of the teams that are coming through.
Great. Mario?
Richard, was that towards me? I'm sorry.
Yes, that was, yes. So what do you look for in a company before you make an investment?
So it depends on the stage of the development of the company, but typically as an angel investor, very much what Gina had indicated, and which is really the team. I mean, you can have a great idea, wonderful idea, earth-shattering idea, but if you can't execute on the plan, or execute on whatever you're trying, your business plan, it just doesn't work. So for me, team is number one. And then number two would be the idea itself. Does it have intellectual property? By the way, has the team, yes.
Thumbs up. Where's my thumbs up indicator here?
Yeah.
Here's my reaction. Thumbs up. Yep. Intellectual property. Go ahead.
Yeah. And who owns that intellectual property? That's a whole nother subject. But it's really the team. Most importantly, has the team worked together in the past? Okay. There's a lot of serial entrepreneurs that have shown some success. Most of the time, it's a good jockey to ride on the horse. But in reality, it's the team. It's all about the team. And then now what's interesting, Richard, is that the team, even though they start executing a plan and it runs into some problems, they have the ability to pivot. So that's another important factor in the team. Can they pivot, and can they work together? So
in a way, if you've screwed up in the past and you're pitching for funding and you can show how you pivoted in a different direction, that's actually not a bad thing, right?
Well,
I mean,
Richard, it all depends on whose money you've screwed up. Okay.
I'm sure that's a very valid point. But I do remember at some of the presentations that you've made, you had a checklist of things that you looked at when you were evaluating a company, and you shared that with the group. I think this was John Carini's group or something like that. And is that something that you could share with our audience at some time?
Well, with the audience, yes. And it's really,
I mean, if they emailed it or requested it or something like that.
Sure. It's really what I refer to as the due diligence checklist.
Right.
That's really it.
Okay. And Abby, what are your criteria?
So definitely echo what all the other panelists have said about team. That's always the most important thing for early stage investments. You could have the best idea and best business in the world, and the wrong leadership just would make all the difference. Another thing we look for, is the idea differentiated? Is the business actually genuinely doing something different? That's another important thing. I see, we see thousands and thousands of businesses a year, and we only invest in 5 or 6. And we just see the same business over and over and over so frequently. It's very important that if you want to get investment, you're building something that's truly differentiated. You're solving a problem that's genuinely real. You're not just building something that's a nice to have for people. You're building something that's solving genuine pain and is different from what else is out there. And then the final and probably the most important thing that we look for is size of market. As an institutional VC, I think I might be different from some of the other angel investors that are out there as far as this perspective. Angel investors can have all sorts of different perspectives on return threshold because they're investing their own money. For us as institutional investors, we manage money on behalf of others, and our LPs have a certain return threshold that we're expected to hit with our fund. And because the venture model of investing is so risky, most of the companies we invest in are going to fail. And we know that. And we go into this style of investing with eyes wide open and knowing that. And so with that said, in order to meet the return threshold we have to meet for our LPs, the companies that are successful need to be really, really, really successful in a big way. So every business that we invest in, it needs to have the potential to have a multi-billion-dollar Uber, Airbnb size exit opportunity. It has to have that, what you call unicorn potential. Obviously, not every business is going to get there, but because not every business is going to get there and we have those return thresholds we have to meet, the ones that do win need to win in a really big way. So a business that's a nice business that we think is going to be moderately successful and produce a small amount of nice profits, that's going to be a pass for us. Even if we like the team, we like what they're building. But if we don't think it has the potential to have that multi-billion-dollar exit, it doesn't fit with the venture style of returns, and it's not something that we're going to put our money into. So,
wow, multi-billion, that's a lot. When you say you see the same businesses over and over again, what do you mean? I mean, is it just, it can't possibly be identical businesses, right? But what do you mean by that?
Businesses that are solving the same customer pain point is how I would phrase that. So, there's a lot of an example of one I see a lot is like virtual meeting software, virtual event software, virtual conferencing software. There's so many of those. It's obviously a big pain point, but you building a widget that makes the meeting a tiny amount marginally better for people, that's not something you're going to build a multi-billion-dollar business off of. You might get a few customers here or there. And I want to clarify that by talking about businesses of that size, I'm just saying those are the types of businesses I'm looking to invest in. I'm not saying that businesses that aren't of that type are bad businesses. So please don't misunderstand. I'm not saying that the founders of small businesses are not good founders or that those businesses are bad. Venture capital funding is a style of funding that only makes sense for a very certain type of business that has that scalable potential and for a very specific type of entrepreneur that's interested in pursuing that. So if that's not you, that's not a bad thing. It just means venture funding isn't the right type of funding for you.
But when those come up, there's competition for those businesses too, right? Sometimes they just fall in your lap, but they're obviously looking at other investors, right? So,
Sure.
If you've got a unicorn, then hopefully you're playing your hand well. So
absolutely, and we syndicate those investments as well. So we'll collaborate. A Series A venture round will have lots of investors in it typically. So we usually lead the round, and then there's usually at least 3 or 4 other investment firms that also come in and participate in that round as well.
Great. So I'm going to skip a question because I think, and that was, what do investors look for? That was Gina's question, but I think we kind of answered that already. But the next question for the panelists is, how much of the company do you take for your investment? So obviously you're expecting the owner of the company to give you some equity in the company. What does that look like for your investments? And I guess Mario, you look like you're concentrating there. So I want to put that brain power to use.
Well, Richard, whenever you speak, I want to concentrate on what you're saying. So, so it's a interesting question. So typically, when an entrepreneur approaches me and we start talking about equity or convertible note, or what piece of the company, should I expect the series of funding? Okay. So in reality, what I tell most entrepreneurs, that you can expect the network of angels or group of angels probably to take anywhere between 15 to 20% of the company. Okay, and it all depends on what stage you're in, what kind of traction, but it's really 15 to 20%. And what I mean by that is, if you're trying to raise $1 million, you should expect to give away 15 to 20% of your company. Okay. And there's also different ways that you can structure the deal where you're not taking the full 15 to 20% at one time, maybe based on some milestones that you've achieved. Now, obviously, if an angel investor is going to put in $25,000 to $50,000, there's no way you're going to give away 15 to 20%. So it really has to be 500 to about $1 million. And again, 15 to 20%.
Okay, so can you explain that calculation in a little bit more detail? Maybe I tuned out for a second here. So is there, like, you have a specific valuation? You say, it's the company's worth, $3 million or something like that. You would take 15 to 20% of that $3 million is basically what it would work out to be for an investment of $500,000. Is that? So let's. Have I just completely screwed up?
No. So let's make it a little bit easier. Let's say the company's valued at $4 million post money, right? And you're looking to raise $1 million. So it's valued at, you agree, right? It's between the entrepreneur and the investor that has to negotiate what the valuation of that company is. Okay. So let's say you agree that the valuation is $4 million pre-money. So that means before you put your money in, before the investor puts its money in, the company's valued at $4 million. So with a $4 million investment, and you say, well, I want about 20% of the company. I hope the math works out. So that means that the company is worth $4 million, is maybe worth around $5 million. Okay. So you're taking 20% of the company at the post money valuation. All right. So
got it.
Right?
All right.
Post money.
Now I get it. Thank you very much.
By the way, Richard, the 15 to 20% is really an average that I've seen, I've heard, I've been through. So it's not what actually has to happen all the time.
Okay. Perfect. Maria?
Yeah, I
Sure.
suppose we are a little bit different, again, coming in at the pre-seed stage, the program stage. So for each of our programs, we have generally speaking, a set investment format for each of the programs. So for example, Hacks, our hardware program, based in Newark, focused on teams, building breakthrough tech. The investment structure that we have for those teams is a fixed instrument. So we invest through a post-money safe. Basically, it's a $250K investment for a 14% post-money allocation. So that is the fixed investment for Hacks. Indie Bio, similarly, our life sciences program based in San Francisco. Again, the investment structure there is a form of convertible instrument, again, a safe for $275,000 for an 11% entitlement. We also take a very small, very nominal common stock holding in the Indie Bio program, just a at par allocation of equity. but I suppose that is kind of the template structure. There's always going to be the exceptions. It depends on the team, it depends on the company, it depends on what they're doing, their technology. There's scope for negotiation. You know, sometimes the teams could be a little bit more advanced. They could be actually, you know, in the process of forming a round as it is, and we may come into that round, you know, subject to our own IC processes, etc. But
So
generally, that's the scope.
So you start with sort of a fixed formula and plug everybody into it, right? And bring in companies that meet your criteria. And then there's a little wriggle room here and there. What's a convertible note?
Okay, so the form of convertible note. So you have two forms of investment structure, generally speaking. From our perspective, you have your equity, which is a direct purchase. Like Mario was talking about there, you're going to come in for your 20% post money. You're getting shares on the cap table right there. You're paying your cash up, getting on your stock certificate. The convertible is a different form of instrument. It is basically a form of, you know, it's a form of a promise of a future allocation of shares. So you don't get on the cap table straight away with your convertible instrument. That instrument, so we would pay the cash now, and at the point in time, at a future date, when you hit a milestone, that being a funding round, when you secure cash investment into your company, our instrument then will convert to equity at that point in time. So, you know, this is a fairly typical, you know, it kind of stems from the YC kind of safe instrument. Your traditional convertible loan note is a little bit more, I suppose there's a few more pages in your convertible loan note, but they're convertible securities, they're convertible instruments. They convert basically at a future date for a future allocation of equity at a, generally speaking, a discount to the convertible note holder.
Yeah, the longer the contract, the less risk for the investor, right? So
that's it. Yeah.
Abby, tell us about what your opinion on percentage ownership.
So we typically look to get around 10% ownership in every company we invest in. Obviously, like Maria said, it varies depending on the deal. But as a lead investor, we're typically the one that sets the terms. So basically how that works for a price round. So we do price round, which is straight equity purchase. We don't do convertible notes or safes because we invest later stage than SOSV and some of these other earlier stage folks. So we do price rounds only. We're the lead investor, which means we're negotiating with the company, with the founders for the terms. And then the other investors that are also participating in that round will follow. They'll use the terms that we set. So that's a bit of the structure of how it works. We look to get around 10% for us. And then typically we're taking about half of the round. So you should look to give up around 20 to 25% total for every round that you do. Then the other investors will take the rest of that. I would strongly recommend against giving up more than 20-25% of your company in one funding round. Because remember, that's just one funding round. You're then going to need to raise another funding round and probably another, and then another, you know, depending on how big you want to get. And you're the founder, you're the entrepreneur, you're the one who's taking all the risk and putting in all the hard work.
Keep some for yourself. Yeah, right.
Exactly. You want to get your payout at the end.
Gina?
So I totally agree with what everyone said. I mean, I think the numbers say somewhere between 15 and 20, depending on the round, but I'll put it a different way, just from an entrepreneurial point of view. If your valuation is going up and you give away your percentage ownership, technically, if you're successful, you'll have a smaller piece of the pie, but it'll be worth a lot more. So I think what you have to understand, when the early stage investors come in, we might be getting, 20, 30, we'll get a little more because it's more risky. So as you de-risk your company, the later stage investors are putting money in at hopefully a higher valuation because that's what you want. And so you'll be giving away a little less, but then you might wind up with 50, 60% of something that's worth a whole lot more. So just kind of think about, it's a little bit the financing strategy and understanding that when you give up ownership, we're all betting together that then that ownership, that pie increases rather than, we're cutting up this pie and it's getting smaller. We want to see it get bigger.
That's a good point, because if you don't appreciate that, then it's going to be hard to sign a contract, right?
Correct.
I would point out that recently I had some communications with the New Jersey EDA, the Economic Development Authority, and they're coming out with some really interesting programs now for investors who are investing in New Jersey companies. One of them is the Evergreen Fund, and it's funded by tax credits that companies sell and larger companies buy. And the money that comes from those auctions gets put into this fund called the Evergreen Fund. And they're coming up with 2 new programs that I think would be interested to anybody. One is a venture matching program. So you have an Evergreen venture program that will, for qualified venture funds, will match. The government will match what the investor is putting in. And they're also going to have a matching program for angel investors as well. So I was asked to review the documents for these programs along with a small group of other attorneys, and they're going to be rolling out fairly soon. They're going to hope to be signing contracts in December. So if anybody, if you haven't heard about this, I think it's an excellent opportunity. And I have to commend Governor Murphy for really actually trying to take a different approach to investing in New Jersey and really promoting the entrepreneurial system. So I just want to, if anybody wants more information about that, you can contact Kathleen Coviello. She's kind of running the program, or you can contact me and I'm happy to pass your information on. But they'll have, if you subscribe to the New Jersey social, the EDA social media, there'll be official announcements when these programs are actually in effect. So I'm going to skip around a little bit. We've got about we're about an hour into our presentation. Is anybody bored yet? Do you want to quit, or do you? I'm not bored. I'm having fun. So maybe we could get to some questions then. One question though, and I didn't want to forget this, was I want to make sure that the panelists can recommend some written materials or other sources of information for people who are just now getting into the angel investment, venture investment world. Are there some written materials, courses, or anything like that that you would recommend so that entrepreneurs can educate themselves? So, Mario, what are your recommendations there?
One of the things when I started the company and trying to figure out what to do financially, and then even when I became an angel investor, the thing that was very important to me is understanding a term sheet. Okay, so basically a term sheet is the summary of the deal that you're making with the investor. And if you were to ask me what the title is right now, I just can't remember. But it's really a book on term sheet, and it explains most of the terms that go into a term sheet, and it's very good. And one of the hiccups that I run into with a lot of entrepreneurs is, what's a term sheet? How do I become familiar with those terms in the term sheet? Yes, you should get an attorney involved to help you negotiate the terms and then the agreement. But at the same time, you should be aware and familiar with what those terms mean and what the impact is to your company. I just can't remember the name of the book.
Can you summarize for us in 2 minutes what goes into a term sheet?
Oof. So what really goes into a term sheet?
You'll have to talk faster. No, just kidding.
Okay. So it's really the understanding, again, between you and the investor. It talks about the value of the company, how much equity, how much money's going into it. Is it a safe? Is it a convertible note? Is it an equity? Okay. It also talks about what happens if the company fails, who owns the property, talks about intellectual property. It's quite a bit. It's a lengthy. It's quite a bit. That's what I
So
could
it's
say.
kind of a bare bones outline of
Yeah.
what the deal is going to
Of
look
the
like.
agreement. Absolutely. Yep.
Okay.
Yep. And
Very
you
cool.
need to understand the implication of some of these things. You know, they are complicated. And if you're an experienced investor, you may be able to explain it. But really, it's where you end up getting an attorney to define what these terms are and what the implication is.
Yeah, I mean, and you know, these negotiations, it's hard to change your mind after you've put a term sheet out there and everybody's looked at it and agreed to it. So you really got to know what your offering is and what you want when you go into the deal, right? And it is possible to make modifications, of course. If somebody wants to change this up here, then you may be entitled to change something down here, right? But you need to have a clear picture of what you're doing. And you know, you should get the help of either an experienced investor, legal professional, when you're creating these things, so you can really think through the processes that you're going to go through, and how it's going to work out, right? So you really want to be spot on. So you approach an investor, you got to hit a home run, right? And so you got to make it good. And I just can't resist saying this, but make sure you put your economic evaluation in the slide deck. I've seen so many decks where people don't talk about how the investors are going to get their money out or how much money they're going to get and why that even makes sense. So, you know, make sure that you have an economic evaluation in your deck, and it probably should be like the second or third slide, because that's, at the end of the day, if people see that there's potential for a lot of money there, then they're going to be interested. If you've got to go through a whole long thing and then it's at the end, you know, maybe you'll still get the deal. But I think presenting that financial piece up front is, I've heard that it's it's effective. So so Gina, do you have any resources for entrepreneurs?
Yeah, I actually put a couple in the chat. So one of the books that I love is called The Founder's Dilemma, and it talks a little bit about, do you want to be king or do you want to be rich? There's perfectly, scalable, businesses that an entrepreneur can have that they won't ever need outside funding. I mean, that could be, and you can make a wonderful, return for yourself off of that. So if you want to be king, maybe that's the way to go. What Noam Wasserman from HBR, which Harvard Business, he wrote the article and the book, says is that if you really want to be king, then you need to really think through what your term sheet and how you do your terms. So there's a lot of great information and just kind of the thought process of where your business is on the spectrum and kind of what do you want to be, what kind of entrepreneur do you want to be, and that'll inform your type of financing. And then the other thing I would say is a more practical kind of resource is that Golden Seeds does information sessions and office hours. So you don't need to apply. We love to mentor companies that are really early stage. We have office hours in all of our chapters at least once a month. You can sign up for any of the office hours. If you're in New Jersey, I would encourage you to kind of meet the New Jersey folks, or New York, we do them all over the country. There's an information session as well, so you can learn a little bit more about what the investors are looking for. And so I would say, you really want to research your investors. It's a marriage. It's, you want to understand what investor kind of matches with what you're doing.
Perfect. Maria?
Yeah, I suppose I think the book that Mario might have been referring to could have been Brad Fell's Venture Deals. It's kind of a Bible, an institutional Bible for entrepreneurs. Also, I suppose, look, educating yourself on the terms. I think that's a really good point. I think it's very important. There are loads of resources available. NVCA model documents. So that's the template form of document that is used within the US, for rounds, for investment rounds, price rounds. They're really, really handy. They can be quite daunting. There's a lot of footnotes in there. There's a lot of information, but, even just reading through those, getting an idea, taking in the content of the footnotes really would help entrepreneurs when they're going into funding mode, I suppose. The other thing is, I suppose actually on the terms, our managing partner, Sean O'Sullivan, does a VC Lingo series on YouTube, and it is basically Sean explaining VC terms in very short, quite entertaining fashion. It's really, really handy. Just to kind of, he goes through the whole lot of the, I suppose, the alphabet of the VC lingo that's out there, and just explains those terms. Additionally, cap tables, you have to be able to understand your cap table when you're going into a funding round. You need to understand the consequences of all the different types of funding. Currently, are you going into potentially a down round? What are the consequences of that? What are the anti-dilution impact? You need to be able to model those model out your exit scenarios, etc. So the Khan Academy actually is a really good resource. They have really, really good modules available. It's for free. It's available online. They work through cap tables, from every stage. Really, really simple terms, just very clear and simple terms as to how you model through each of your cap tables with worked examples. So that's a really handy resource. Again, to echo there, the office hours, take up the opportunity to engage with investors through their office hours. A lot, most investors, most VCs have those. Certainly on our own website in SOSV, you can engage with any of our GPs. Get a 30-minute slot, have a chat with them. They'll if anything, they'll give you a bit of a steer or give you a yes or a no, which might be the only thing you need. So that's a really handy tool. But I think, really educating yourself before you go into a pitch or before you go into fundraise mode, as I said, is really important. And I have to give a shout out to the lawyers, engage with your lawyer early and often, but you can't
Especially
outsource.
often, yeah.
Early enough, yeah. You can't, but you can't, fantastic and all as the lawyers are, you can't just outsource everything. You can't just, hand your round over to your lawyer and say, okay, here you go, take this, close it out. You have to be engaged in the process. I think you have to, there's a saying, work hand in glove with your lawyer, so that you can get through to the execution and get the cash in your account in as swift a manner as possible. I think that's really important.
And what's a cap table?
What is a cap table? So a cap table is a capitalization table. It is basically, in its most simple format, it is a table that sets out who are the people who own shares in your company, how many shares do they own, what class of shares they own, because as you go through your funding rounds, each investor wants the newest, shiniest class of share. They want the top preference. They want to get the first return on an exit. So, each round will bring its own class of shares. So you need to designate who owns what class, what percentage. Basically, who are the parties in your company that comprise the whole? So what is the 100% ownership within your company? Explained on a cap table. Start out very basic, and then they can go full on cap tables. You'd need a few screens maybe to manage some of them, but they're so important. They are the first document that the majority of investors will look for in any of your follow-on rounds. They need to know who is on your cap table and what is their percentage available.
Abby, I see that you're putting stuff into the chat here, so.
Yeah, I'm sharing a few resources in the chat. Would definitely second Venture Deals. It's a fabulous book and resource. Brad Feld, one of the authors, he's also very active on Twitter. He has his own personal blog, which are worth following as well. There are some VCs that are really excellent about putting out blog posts that are really helpful for founders. First Round Review is one of the best. I would definitely recommend following them. Equal Ventures is also very good. Primary as well for pre-seed and seed stage startups. They have a lot of great resources. They have a founders fellowship program also that I definitely recommend. They're focused on local founders, New York, tri-state area founders as well. So I would definitely recommend checking them out. And then finally, I would just say that the vast majority of this stuff, in my opinion, is best learned by doing and not by reading. And I think that the more you can have conversations with people and build out your network and get the sort of hands-on experience and have real conversations with real investors, the better you'll learn all of this information. In my opinion, that's a much better way to do it. It's fine to read a book or a blog post to sort of lay the groundwork, but it's never too early to get out there and start building your network with VCs, start having conversations with VCs, even if you're super, super early stage and you're not going to be a fit for investment for them right now. It's still not harmful to, reach out to them on Twitter, go to events where they might be, ask people in your network for introductions. Because at the end of the day, this is a network and people-based business. And so much of getting funding is all about who you know and what conversations you're having. So I'd say spend more time doing that than you do reading anything.
That is that is certainly true, because you have the opportunity. And I mean, this is complicated stuff, especially if you're not living in the world of VCs and angel investments, right? All the time. You're working on your business, developing the software and stuff. And so to try to pick it up from a book, I think is a great start, but you really need to learn it from experts, as our panelists are. So I have a question here from Michelle to everyone. It's now time for the question, the experts part of the program. And so strap yourselves in, you may get some tough ones here. Is there a New Jersey equivalent of Jumpstart New Jersey? I'm sorry, is there a New York equivalent of Jumpstart New Jersey? And that was from Michelle to everyone.
I can answer that if you want. I just put in the chat the Angel Capital Association website. So
Okay.
angel groups exist all throughout the country. Before COVID, as Mario alluded to earlier on in the program, we used to invest, kind of more locally. So there are angel groups in, pretty much every single state. If you go to the angelcapitalassociation.org, you can find a list of angel groups anywhere in the country. So you could take a look. Usually there's links to their websites. There are quite a few angel groups in the area, in New York, New Jersey, Philadelphia. So, I would encourage you to take a look at that website, and you'll be able to find the group that more information on each of those groups, and that could be part of your research, and reach out to those groups that might be interesting for you to connect with.
So do you think it's better to get a warm intro to an investor versus, filling out a form in Gust or something? Or, I mean, does it make a difference? Are you, in your opinion?
I think it's better to meet the people in the office hours, because that is kind of no risk. So I would start with anybody that is doing office hours, kind of reaching out, what Abby said, talking to people at conferences, going to places where the angels and the VCs congregate, and kind of doing that first. I would caution against just filling out the application and, not having some kind of previous conversation with at least somebody at the firm.
Yeah, I mean, that really makes sense to me, because you can really form a relationship, and you can see if you're a good fit, and if nothing else, you'll gain some information, probably learn some things that you didn't know before, and the venture people who attend the conferences or have the open hours are doing it because they want to help and they want to meet people, right? So that sounds like a great advice. Here's one. This is from Dave.
Sorry, I thought you was like.
I'm sorry?
Sorry, I totally muted it. Don't worry about it.
Are we in trouble?
No, continue. You're good.
Okay. All right. I don't want to get my license pulled. Here's one. Differences between a line of credit versus loan versus angel investment. So Mario, you kind of talked about the cycle. Maybe you can go into this a little bit.
So let's see, you go to a bank and you can borrow the money.
I'm all waiting for mom. She waiting.
Okay. we're still on. We'll continue.
Yeah.
So line of
I
credit.
kind of want to hear what they're talking about, but go ahead.
Oh, come on. You mean what I'm saying isn't that interesting?
No. We can do both. Anyway, go ahead. I'm sorry for the interruption.
So again, earlier I mentioned your options, right? You go to the bank. So one of the things you can get at the bank is a line of credit. Again, you have to provide collateral to do that. And basically a line of credit, let's say you go to the bank and you convince them to lend you $100,000.
Yeah, I was waiting for your medicine.
Sorry, I totally removed her. Go for it.
She's
Gone. Done.
She's
You're
off the island.
mediated.
Yeah.
off
done.
the island. Yeah.
Yeah.
She
So
can
you
listen
go
to
to
the
the
rest of the broadcast
Yep.
on podcast.
So you go to the bank, you convince whoever the banker is that you're worth investing in. So you get, let's say you need $100,000, but you don't need it all at once, right? You need it as you're developing your product or your business. So you get a line of credit. And basically what that means is that you have the ability to draw down on that line of credit, right? $100,000. Today you need 10,000. Tomorrow you need 25. So now you're up to 35. In 3 months, you need another 15,000. Now you're up to 50,000. It's basically a loan with some interest. It could be floating interest or a fixed interest. Okay. So you have that. Then you've got, what was the other one? A convertible note. And so what's a convertible note? So it's interesting. What hasn't really been spoken about is a safe versus a convertible note. Okay.
Mhm.
Those two vehicles are basically the same, except for, which is very important for the entrepreneur, a safe is a promise to give you equity. All right. And the safe, or the value of the safe, doesn't usually show up on your financials. Got that? Okay. Where a convertible note is a liability on your financial statement. The two vehicles are basically the same.
Are investors using more safes or less? It's
No,
not really a
less.
preferred.
No,
preferred.
that's correct. So as an angel investor, I would prefer a convertible note because then it's a liability and it's an IOU of your business, where a safe is not. It's a promise, not necessarily an obligation. Okay. I mean, yes, it is an obligation, but again, it doesn't show up in your financial statement as a liability. As an investor, we try to stay away from safes. Okay. As an entrepreneur, I would love to have a safe. Okay. The convertible note's a little bit more complicated and the safe is much simpler, right? So now you have a bank loan or line of credit. You now have either a convertible note or a safe. Then the next is really an equity, where they actually give you, the investor buys a piece of your company. And then there's certain terms to that equity. An equity round is a lot more complicated, and the attorneys love equity rounds because they can draw up the beautiful documents, okay? Where a safe you can get at Y Combinator. You can just go and you'll get familiar with it.
Get it online,
Hi, Richard.
So I appreciate that, and that's a great explanation. I have a question here from Anatole Norland to everyone, and she says, "Thank you to our panelists and hosts." So thank you. One question: how are startups differentiating themselves since the pandemic happened? That's an open forum. Anyone who wants to. Any panelist who wants to answer that question can jump right in. Abby, I think you're got that. I want this one look on your face.
I'm happy to talk about that a little bit. I think maybe it's more relevant to talk about more in light of the current funding environment. As those who follow financial market news know, it's been a rough year in 2022, and it's a tough funding environment. Less so for early stage startups. I'd say public markets and late stage companies are getting it the worst, but it's starting to trickle down into early stage companies as well. So some things that I think founders can really do to differentiate themselves, being cash efficient is super important. That's something that I think during the boom times of 2020 and 2021, which we talked about earlier on in the panel, wasn't as important to investors. And now that we're starting to hit some snags and head into a downturn is becoming a lot more important. So wanting to see.
I was just gonna ask, with the market seeming to turn down now, should we be getting more pessimistic? Do you think it's maybe better to build your business plan over a longer term? It might take some more time to get funding, or do you think it still makes sense for us to go for it?
So there are still investors that are out there deploying capital. I don't want to perpetuate this myth that there's not. We're one of them. We have dry powder. We're deploying capital. 2020 and 2021 were record years for venture fundraising as well. So VC firms also raised a lot of money during those 2 years. So there is still capital out there to deploy. However, I think investors are becoming a lot more selective about the kinds of companies they fund. So again, capital efficiency is really important. Having good gross margins, paying attention to your unit economics, not sort of having that growth at all costs mindset and I'll worry about profitability later. I think that mindset was really popular in 2020 and 2021 and is now starting to go out of style in the VC community. So I'd say, if you need capital for your business, go out and raise it. There is money available, but make sure that you're being conservative with your cash and that you're having those conversations with investors where they know what your plan is to scale in spite of the market conditions and that you'll be good stewards of their capital.
Perfect. So one last question. We're getting to the end of our program. And it's for each panelist, and that is, what is the one thing you've learned in business that you want to pass on to the audience? So we'll start with Maria.
Okay, I suppose it's not a business related term, or it's not a specific VC investor related term, but I think be respectful. It is, at the end of the day, it's a small enough community. Okay, you might not get the result you want, or you might not get what you were looking for exactly from your pitch. Learn from it, move on. You need to keep your options open. I think just be respectful of the other people in your community, of your investors, of your co-entrepreneurs. You will likely have a long road, ahead of you. It's not going to, well, it might happen overnight and fantastic, but it's a long road. You want to engage, you want to maintain your relationship with your investors, with your investor base, with your network. I think there's nothing to be lost by maintaining a respectful approach to your community.
So be nice to people on your way up, because you may be meeting them on your way down, right? So, Mario?
Interesting. As an investor, as an entrepreneur, and you've had some success in raising capital, make sure you communicate with your investors. All right, let them know the ups and the downs. And as an angel investor, as an entrepreneur, I understand the ups and downs. Okay, surprises, don't want to hear about them. I want to hear about them, but if it's a surprise, it's not a good thing. If you communicate with your investors and you let them know what you're doing, what the problems you have, your successes, I think it's a good thing to do. Amongst other things.
Yeah, no, I couldn't emphasize that enough. The things that drive any business person crazy are the things that come out of left field, and you just didn't know about them, right? And so then you have to scramble. So I'm with you there. Gina?
So interestingly enough, I'm an engineer by background, so maybe it's the fact that technical problems to me, that's an easier problem to solve. But I found during my career as an entrepreneur and also as an investor that the technical problems can typically be overcome. It's really the people problems that kill a business. So I would kind of echo a little what Maria was said, be nice, but also make sure that your team dynamics are good, make sure that you're communicating, make sure that you're understanding, kind of those soft skills, and you're bringing people along and you're all working out for the same goal. So I would say, just be aware that it's not only solving those technical problems, because some of those entrepreneurs get their head down and they're solving those technical problems, but you really need to focus on the people around you as well.
Abby?
I'll just echo once again that it's a people business. Raising money is all about people and relationships, and your relationships with your early stage investors are 7 to 10 year relationships at least. And I think there's a great stat that we talk about a lot at our firm about how the average investor VC relationship in the US lasts longer than the average marriage in the US. So, think about your early stage investors in that context, right? Is this someone that you want to get married to? A good founder VC relationship should feel equal, and it should feel two-sided. You shouldn't feel like the VC's trying to act like they're better than you or smarter than you, that you shouldn't feel like they're trying to cheat you. Obviously, you should feel like they're your partner and they're trying to help you and they're treating you like an equal. So if an investor is behaving not in that way, don't work with them, and vet your investors just as heavily as they're vetting you. Due diligence is a two-way street. You should be choosing the investors that you want to do business with just in the same exact way that investors are choosing the types of companies that they want to invest in. So, be respectful, treat everyone with respect, treat everyone like a human being. Investors are human beings just like you. I think a lot of times founders that are disconnected from the process cease to view us that way and just view us as vehicles to capital. And that's a recipe for not getting funded. So treat everyone like the human being that they are, and build those long-standing multi-decade relationships. And that's what'll give you success at the end of the day.
That's great. Everything I need to know, I learned in kindergarten, right? I mean, that comes down to it, right? So it's been a marvelous program, and I can't thank the panelists enough for taking the time to share their expertise and their knowledge with our audience. I don't know, can we take everything off of mute, David, so we can give the panelists a round of applause? Yay! All right, so that's great. The panelists have graciously agreed to share their contact information. I'm not really, what's the best way to do that? Does anybody have any suggestions? I think, they're obviously available through their websites and their companies and through their offices. Does anybody have any other things? I guess if you want, you can, the panelists can put their information in the chat. And we'll take it from there. But thank you very much for joining us. We appreciate your attention, and we hope this was valuable. And we'll be back next month with another entrepreneurial strategy series. So we'll see you then. And don't forget to like us, Gearhart Law, on LinkedIn. So please do that too. All right. Thank you.